Welcome to After Hours Action on the Street. I'm Greg Greenberg in New York. We've got earnings season kicking into high gear with reports from Yahoo and Intel out just moments ago. We'll get to those in a minute. But first, here's a quick look at the closing numbers. Major U.S. stock markets sank Tuesday. Investors digested a disappointing earnings report from Citigroup and worse than expected New York manufacturing report. And of course, the continued gridlock in Washington was certainly no help to investor confidence. All that led to lower stock prices, with the Dow down 133 points, the S&P down 12, and the Nasdaq down 21. As far as commodities, oil slipped $1 while gold popped $6 in regular trading on word that a compromise was, alas, not in sight. Our top story at this hour: shares of Yahoo are higher in extended hours trading after the company posted 34 cents a share in earnings. That's a penny better than Wall Street forecast, though it's down from 35 cents last year. Yahoo met the Street's revenue estimate of $1.08 billion, which is about flat with the year ago. And shares of Intel are also slightly higher at this hour after posting profits that beat expectations. Intel reported third quarter earnings of 58 cents, which were a nickel better than Wall Street's estimates. As we all know, the pressure is on Intel's new CEO to find sales outside the slumping PC business. Revenue rose slightly to $13.48 billion from $13.46 billion last year. That was essentially in line with Wall Street estimates. Margins were a bright spot for Intel, even while the chipmaker's fourth quarter revenue guidance came up a little short at $13.7 billion. And Tesla was a big name on the street today. Tesla shares were up another nickel in the extended hours. Tesla stock finished over 2% higher to $184. The stock rose as high as 5% today on the strength of a bullish Wedbush Securities report. Wedbush upgraded Tesla from neutral to outperform based on an in-house survey on how Tesla's Generation 3 model will be received by car buyers around the country when it hits the road in 2017, so you'll have to wait for the car. Of course, all these earnings reports are coming as our friends and representatives in Washington are fighting to end the shutdown in D.C., but you can forget the small-minded politics creating gridlock in the Capitol. The real economic threat is too much of everything: labor, goods, money, you name it. Here to talk about that is Daniel Alpert. He's the author of The Age of Oversupply. Welcome, Daniel. And tell me, a lot of people think that we are in a recovery right now, but you think we're headed towards the edge of a cliff. Tell me why.
Well, it's nothing proximate. I mean, you look at it's very hard right now because economic data has stopped as a result of all the stuff that's going on in Washington. But you saw the New York Empire Fed manufacturing survey today, very weak numbers. This is continuing a trend. We had a little bit of an uptick a few months ago, but that has petered out. The bottom line is that we're experiencing the after effects of really a 15-year cycle. When you look back 15 years ago, the emerging markets were really nothing to speak of. They had just essentially earned their freedom with the fall of socialism and what have you, and they were building their infrastructure and starting to compete with us, and we saw references to outsourcing and offshoring and things like that. That ultimately grew into an absolute monster wave of excess labor, excess productive capacity, and excess capital that all flowed back into the global free market system. Looking at it from a standpoint of magnitude, you had 3.5 billion people in the BRICS suddenly show up and say, you know what? You guys in the advanced nations, the 800 million of you in the advanced nations, a much smaller number, we'd like to live how you live, and we're going to work a lot cheaper to do it.
Let's talk about the capacity glut, which you write about in your book. Now, is it the fact that these members of the emerging market, they can make a whole lot of stuff, and we just don't need that much stuff anymore because during the housing boom, we bought all the stuff we needed to fill our houses?
It's not necessarily a lack of demand. Obviously, during the recession, there was a drop-off in demand, as would be the case in any severe recession, and that demand was pent up, so we saw some emergence of new demand when we came out of the recession. It's not necessarily under demand, it's oversupply. It's a very, very different concept. Normally, this would be taken care of by adjustments to what the economists call the pricing mechanism. Prices would fall in order to clear the market of all of these excess goods. But unfortunately, that threatens, at least in the advanced nations, that threatens the entire pricing and wage and asset infrastructure of these economies. And so what's happened with all of this monetary easing that's gone on both in the United States and in Western Europe is you've seen in the Eurozone, you've seen all sorts of efforts to bolster the economy, to basically keep away the threat of deflation or disinflation. If you want to look at what deflation looks like, just look at Japan. 20 years of on and off deflation, complete collapse of their asset structure from the point of their bubble 20 years ago. And you're looking at a country that has maintained their competitiveness, not only against the Asian tigers, the 4 countries that emerged in the late 90s, but also against China and all the BRICS. And still, it manages to eke out a small trade surplus.
So is that where you see the United States heading? Will we be following Japan's path?
We're trying everything we can not to do that, and so far we've been successful, but unfortunately that involves sweeping a lot of things under the rug. These are problems that really are the backbone of the thing that you're seeing in Washington today. You have 2 different views of the world. People who believe we should fall back on the older solutions, those solutions that were popular and effective in the late 70s and the 1980s, which are typically known as supply side solutions. Cut taxes, get people to invest more in new capacity, create new jobs. If you have global overcapacity, however, that doesn't work. And of course, the recovery has been anemic.
So what's the solution and where does it start? Does it start down in Washington, D.C.? Because right now they're not getting a lot done down there.
Right. Well, again, you've got politicians stuck in a very, very old mindset. They're fighting what I call a 35-year-old war. They're fighting the last war, not the current economic war. And the Age of Oversupply is basically focused on making sure that people understand we're in a different environment. We're in an environment that has been affected by what can only be regarded as a historical anomaly, right? Suddenly you release 3.5 billion people, half the population of the world, into the global labor force, when for 70 years they were behind the bamboo curtain and the iron curtain. I mean, come on, this is a complete game changer, and people are not adapting to this. And that's why this book, I think, is very, very important for people to read. Certainly important for everybody in Washington to read, but as a practical matter, important for every citizen of the advanced nations to understand.
All right. We're going to have to send them some copies. Thank you, Daniel Alpert.
Great to be here.
And there you have it. Please come back for more after-hours action tomorrow. Thanks for joining us. And Daniel Alpert, I'm Greg Greenberg for The Street in New York.